What's up, guys? I wanted to go through this video with you guys because realistically, you should be doing these things. I was looking at something about how to actually vet a fund or a syndication or a deal that you're looking at. And these are some questions that I feel like before you wire anybody money or before you make an investment in any real estate deal or a fund like mine or something, you should be able to vet so that way you can do your own due diligence. So whether you're making your first investment in a fund or you're revising your due diligence checklist, maybe these are some things that you want to ask, and I'll kind of go through these and answer them the way that I would if you were talking to me. So, if you were vetting a fund or a syndication as a deal, number one thing that you want to make sure that you ask questions about is the sponsor. Like, for example, is this the sponsor's first deal? Or did you just get started 2 years ago and you've never done a deal in your life? You've never went full cycle on a deal. You've never bought another deal. There's nothing wrong with somebody that's getting started. Maybe they have a different background. Maybe they've done something in a different business that gives them the expertise, but you do want to find that out. Maybe they have a powerful team. Like for myself, I've been doing real estate since 1997, 1998. I've done a lot of deals. I went full cycle on all my deals because I sold all of them. So we always got our investment capital back. We've always done really well on those things. Some we did great, some we didn't. But I have the experience to know what it feels like when the door shuts closed in a real estate cycle and you're stuck in a deal. What do you do? How do you handle it? How do you handle the ups and downs? A lot of people don't know how to do that. Some of them are just having that experience today. And a few years ago, it was easy to raise money. You go online, hey, I got a deal. People throw money at them, and now it's getting hard. So now the real players got to come out to play. It's kind of like Warren Buffett said, when the tide goes out, you see who has clothes on or their underwears or shorts or whatever. So you want to be able to ask those questions from the sponsor. It's okay if they don't. You just need to do that. Um, Next, red flags. What is it about the sponsor that may give you red flags? You may not like him. He may not like you. You may not like his firm. You may not like the market that they're in. These are things that you need to create your own understanding of what is a red flag to you. But bear in mind, and this is something that I share with anybody, people who want to be limited partners in our fund or other GPs or other syndicators, we're all actually vetting each other. So me as a GP, when I talk to somebody that's interested in investing with me, just as a discovery call or talking to them, I'm also vetting to decide whether this investor is going to be a good investor for my fund or for the deal because it's a long-term relationship. Some people and I find this a lot, like, and you should be this way. It's your hard-earned capital. You should be able to ask every question that you should and get a answer that makes you feel comfortable. But the other side is also doing it. So when I ask an investor, like, hey, have you invested in a deal like this? Is this your only money? Have you ever invested in real estate before? Sometimes people who've never invested in real estate, they want something fast. They've only done trading in stocks, or they have a financial advisor and they want to talk to a lot of different people. They're welcome to do that. That's not a red flag, but if they start wanting special attention because, hey, I'm only going to give you 50,000 even though it's below, and I want you to sign this promissory note outside of your fund, like those are red flags to me to just like, hey, it just feels like you're not the right investor. In the same way that you would vet a sponsor, it's okay to say, hey, just seems like this deal wouldn't be a good fit for me, but it was a good conversation. But you need to mark out in your own way what that is for you and what's a red flag. So next, do you trust the sponsor? Right? Like one, if somebody's lost money before in a deal, everyone says that, oh, I've never lost money in a deal. One of my mentors, he says he's never lost money in a deal. I know a few other people that says they've never lost money in a deal. I've lost money in a deal. I've had to remake that money. I've had to pay my investors back. I've had those problems before. So I know how to deal with them. I've had properties that we've bought I've got sued. I won those lawsuits. I went to mediation. We had properties tied up and we've had these things happen. I know how to handle them. That is the difference. So sometimes people talk about trust and would you invest in a deal with a sponsor or a fund manager who's lost capital? Blackstone's lost capital. Starwood Capital has lost capital. BlackRock has lost capital. Like Larry Fink's lost money. Like, and those people have went on because now they have a lesson that they've brought on into the future and they've mitigated the risk in this future. Like I said, some sponsors have never got into the game or they've never done a deal before or they've never had any problems. So you don't know what's going to happen with this sponsor if they begin to have them because people are having problems right now. So have they lost money? Would you still trust them if they do? I would tell you have like if they can explain to you what happened, how they did right, or maybe some of them didn't. Maybe it was such a big loss. The investors lost capital. They went on to a new deal and made it up in a different deal. That's trustworthy to me. I would be like, all right, well, you did right. Like you did right by your people. You made an attempt. You kept everybody abreast, which leads me to the next thing, which is transparency. You want to be able to be like, hey, is it transparent? Which goes right back to being able to ask questions. Could we take a look at the documents? Could we go through your investor portal? Could we take a look at some of your past deals? Could we take a look at your current deals that you're looking at? Maybe under contract. Maybe you're in a deal right now, right? Maybe they're a syndicator, they have a deal, or maybe like me, you have a fund, I have a fund, and we're underwriting deals all the time. We've underwrote $9 billion worth of real estate deals in multiple markets. We're underwriting deals all the time. And that's transparency. You should be able to see my sheet now. You gotta go in, register, go to bell-capital.com, join our investor list, and then once you're on the list and we know who you are, we can share with you all that information. We do webinars, in-person events, we do a lot of stuff and we share. That's transparency. You want to be able to have that level of transparency with anybody, whether that's, hey, would you jump on a call, sit down, spend some time with me, and so I can go over some more detailed questions, maybe about the sponsor or about your personal situation and see if those things can be handled or your questions can be answered. Because I think that's the right thing to do when you're giving anybody your hard-earned money to make an investment managed for you over an extended period of time. All right. Um, I'm sorry, evaluating value. Like evaluating value, and I put value add. So like if you now you were moving into evaluating the deal, like you want to get a better understanding in vetting the fund manager or the syndication. Now we're getting into how did they evaluate a value situation on the deal they're buying. So like for us, when I'm looking at deals, I'm looking at newer assets that are in great locations that maybe the rents are a little bit low, but they're newer, nicer quality Class B, Class A areas in Class B, Class A markets, right? The properties. When I'm looking at value, like you need to know how the sponsor or general partners are describing what is their value at, right? The question is this: let's say you buy a property and the market goes down, but there's no way for you to increase the value of that asset, then you're going to lose your investment dollars. So you need to understand how like me as a fund manager, when I'm looking at value add, I'm like, hey, I believe we're going to be able to increase the rents in this property because the location is good, the city is good, the asset is good, the quality of the tenants are good, and we're looking at it at market where we know that the rents in that market have continued on to go up for the last decade, 20 years, whatever. Even if they go flat or soften, we know that we can continue to increase the rents, right? Or we can redo the parking lots. We can paint the place. We can put new landscaping. We can talk to the tenants. We can see before we buy the property by doing a lease audit, which is going through and looking at all the leases and seeing that, hey, these people are going to be coming up for a lease renewal within the next 2 months, 3 months, 1 month. We know we can go in and have a conversation with them and talk about a rental increase because there's value there, right? So you need to know as vetting the deal how the sponsor or how your general partner in the deal is actually telling you, hey, we got this deal and it's value add. Everyone says that. It's like a new buzzword. Before it used to be the word reposition. So if you've been in multifamily long enough, back in the day, like, hey, we're going to buy this property and reposition it, meaning same thing, change the name, change the color, redo the parking lot, plant some palm trees, and then, it'll be from like Oak Tree Manor to Oak Tree Villas, and now all of a sudden it's been repositioned to this new thing, new management. So you need to know how this person is actually explaining or how they're going to explain the evaluation of what the new value add component is so you can understand it as an investor. And we're talking about you being a passive investor, a limited partner in the deal. So next, what is the downside? How are they able to explain to you what the downside is going to be? And that's very important because you need to know like, hey, worst case, base case, best case. You need to kind of have that a little bit in your head. I do it all the time. I'm like, number one, do we even want this asset in our portfolio for 10 years? Let's say we had to go past the 10 years and we had to keep it for another 15 years after, another 5 years after that. So 15 or 20 years. Do we want this property at all? Do we want the location? Will this place turn into the ghetto or the hood at some point? Will downtown San Diego continue to have a homeless issue and it's going to overrun the block that our property is on? Or if Mission Valley is going to have some downside, or if we're in Ocean, like if we're in La Jolla, is La Jolla going to have this mass exodus of all the wealthy people that live there and it's going to turn into the ghetto and the hood? Like we need to know that first. Do we want it? What can happen in 10 years, 15 years, 20 years? And then outside of that, could we lose all of our tenants? Like we look at I'm explaining to you what you want to kind of find out from anybody else if you're going to invest. What is the break-even occupancy ratio? Like I was talking to someone the other day and we were talking about Houston properties. The average occupancy for Houston at this point, the time I'm doing this video, is roughly between 90%, somewhere 87%. Sometimes, like it doesn't really get over that because that's a massive rental market from the Houston multifamily real estate market. It has always had a rental problem. I've never talked to somebody who was like, we're 100% occupied. And when I asked them, is that economic occupancy or physical occupancy? Typically, it's physical occupancy. Everybody's there, but not everybody's paying. So when I'm looking at a deal, I'm like, all right, what is our Sorry, guys, I was looking at my phone. What is our break-even occupancy ratio? Because if that is 87% and the market is 89%, that 2% barrier is scary. I'm not going to touch that deal. But if the break-even occupancy ratio, that means all of our expenses, including our debt, and I tend to try to include a little bit extra in there. I kind of puff it up a little. And I'm like, okay, let's say that combination is, you know, I don't know, 88%, 87%, but the market occupancy is at 95, 97, and it's been that way for 5 years, 7 years, 10 years, and it's not really dipped below that, and the market's not solved. That's a better thing for me to look at from a downside perspective. Do I want it? Break even occupancy ratio. Um, what is the projected, what is our performa? Can we hit our projected numbers? Let's say we bought this property and we aren't able to increase rents. We aren't able to stagger the increases over the next, let's just budget it where we don't do that at all. We buy it and for year 1 and 2, we aren't able to increase rents. Do we even still want it? Let's say we can't increase rents for year 1, 2, and 3, and then in year 4, we get this big pop. We make it all up. Is that going to be okay? Do we want that? Or let's say we get this increased rent and somebody bills 5,000 units, in the market that we're in, and it makes the market go soft. Do we still want to be there? And what is that going to do when we go from 97%, 95 occupants, 95% occupied down to what I said before, 87, 88, and we're at break even, and I got to do a call to my investors and go, hey guys, wherever our cash flow is right now, that's where we're at, but we're going to be here and we need to lock in because this is where we are. Not a capital call, but we're not going to get an increase in our income, right? Over this period of time. Yes, that's going to affect our returns, but if we do a collection of returns over a 7 to 10 year hold, we're still going to hit our annualized return overall. We're just going to have a flat line for the next year and a half or 2 years. Like we need to know that from a downside, and you need to know that because that's why I said being transparent, you need to have somebody who's already thought about these things, right? So, like, I underwrite a deal. I do my back of napkin underwriting. We run it through our own system. I have my underwriters that we get our debt from. We send it over to them. They run the traps. Basically, they try to find what could go wrong with this deal. They send over a line of questions that I bring back to the broker. The broker will send me over their underwriting and their financials, and that usually comes along with something that they've already understood because they've run it through their third parties. Then I send it over to our property management company if we really like the deal, and then they do a OpEx, which is their projections on what is this going to take operating expenses wise. How can we mitigate our downside from a management perspective? So I have all these other ways to look at the financial part, which we'll go through, which is this. These are still downside checks. And if you have a fund manager or syndicator or syndication that you're thinking about putting your money into as a passive investor or limited partner, like you need to know that they have all these things done. This is along the line with how do you vet the right deal? This is you doing your own due diligence. And you need to ask these questions. And if you don't, or they don't have answers to these questions that's not satisfactory, then you get the opportunity to choose whether you want to do it or not. Um, Next, I have on here the financing risk of debt. So I just talked about it. Like typically when I'm looking at a deal, we do our own financing underwriting. We're like, all right, we already know the loan to value that we're looking to come in at. We can get 60% on the debt or maybe 61% or maybe a little less. I don't know. But we do our back of napkin underwriting, then we send it over to get the debt sized, get the debt sized up. Then we also try to get a soft quote from Fannie, Freddie, life insurance company, a debt fund. I go out to a couple of other people. I also talk to a few other people that I have in my Rolodex that are commercial mortgage brokers that'll do that. We have the broker that has control of the deal. I have them that I talk to their debt people and then they give me an understanding. We already know we're not going to over leverage the deal. We know our loan to value. I'm always getting an update. And I'm just talking about the debt. This is what I do. And these are things that you need to consider if you're doing your own due diligence on a sponsor. What are the costs going to be? Because yes, there's your financing, but that comes at a cost too. We budget another 3 to 5% of closing. Like, so you may have let's say we bought a deal that was like $100 million. You still need to budget another $3 to $5 million just for closing that specific deal because that is a part of it. That is all a part of closing your deal, your appraisal, your cost of capital, legal fees, everything. You need to know from a financing perspective, moving into your acquisition, that your sponsor or fund manager has already underwrote these things. And when I talk about the risk of debt, is there a rate cap? Like, meaning, did they buy the insurance or could you buy the insurance to make sure that if you were getting a floating rate or an adjustable rate on your debt, if it's not fixed, that you have a cap so it can't go up and you know what that cost is going to be. That cost is actually come down a little bit. It was higher, now it's lower, and I may go back up again, but you need to know these things because these are all a part of the financing risk in your debt. Um, so what else did I miss there that you guys should probably ask? Insurance for sure. That's a part of financing because you can't get the financing if you don't have your insurance. Quotes. You don't just want a quote, you want a binder. I have my insurance guy the other day. We were talking and he was like, "Hey Vic, I know you underwrite at $1,000 a door roughly for a back of napkin or a rule of thumb for insurance, but you can probably do it at somewhere around $700 or $800 a door for underwriting purposes, and maybe that'll give you some room." And I was like, "Great." So what did that tell me? As a risk of the debt and the insurance and the financing side, now I know that in my underwriting, I go back and I go, "Hey, we can underwrite it from 500, I'm sorry, 700, 800, 900, 1,000, 1,200." All of the different things that need to be included. But if you're vetting a sponsor or you're vetting a deal, these are some of the things as a limited partner or an investor you want to find out. Are they jumping through these hoops to be able to get in this deal? Because you need to know that if you're going to invest. Next, the IRR, which is your internal rate of return, or the equity multiple. Like, do you even understand those things? Like, have them explained to it. Every time I go through this, I tend to use the same thing. I'm like, all right, we have 5% return on our money. We're in the deal for 10 years. That's 50% on your money just from cash flow. With the assumption, again, it's only assumption. We did never a guarantee. It's only a target. These are only targets. I'm gonna even put that up there so that way I don't, so you see it because these are targets. These aren't, nobody can guarantee this. These are targets, right? My past performance of what I've done in my lifetime does not dictate what I can do into the future. Nobody can tell the future now. I can present what possibly could happen in the future based on my 27, 20, 28 years, 29 years worth of experience, the $9 billion worth of real estate I've underwritten, and the deals that I bought, didn't buy, and I still continue to underwrite and track. And they've traded again, and I go back to the brokers and I see where I am in the spectrum of what those targeted returns would have been had we got the deal. So we understand that we're tracking. But with your internal rate of return, back to that, if we have a 50% and then we increase the income on the property, whether we raise rents or we got pet fees or we whatever we did to the property to increase the revenues, we got another 5%. And maybe we didn't do that for all 10 years. We only did it for 5 of those years. So now we have what is that, 25, 75%, right? Just in cash flow of that money. Then later we turn around and sell the property, give you your money back, your initial investment back, that comes back, plus I wouldn't sell it for less than a double, right? So within that, that would mean we'd be able, your money would go from whatever it was to almost a 275% return on your money, right? That's that thing. And if we held it for, let's say 10 years in that situation, that would be a 2.75% equity multiple. That's how I explain it. We can go deeper on that. Now, that doesn't take into account bonus depreciation. That's the target to give my investors that through the fund, through that asset bonus depreciation, doing a cost seg or anything like that, passed on to you guys. That doesn't include any of that stuff that would be included in that because you need to do that. Um, and that's how that would be structured if we're doing that. But you need to know at least what that person's target. So if I say we're targeting a 15, let's say a 12 to 15% internal rate of return, and you need to know what my idea of that is. And you also need to have an understanding when I say my goal is to double your money. Let's do a 2x. I'm talking about that. Hey, this is a combination of cash flow, appreciation, giving your money back, and exiting the deal. So you need to understand what somebody's targeted returns are trying to are being because I see a lot of stuff out there. Some people say they have a pref. We don't have a pref return. We took our pref away. Some people have an 8% pref, and then everything over the pref, there's a hurdle. We have a 50% hurdle. Once we get to 10%, the 50% goes down to 70%. So you get 70, we get X. Like all that stuff, you need to understand it. If you don't understand it, you need to ask questions to the sponsor to have them walk through that. We kept ours simple, 80-20 split on the first dollar made with a target of a 15% internal rate of return and a 2x equity multiple. And my goal always is to at least hit a 5% annual, a 5% cash on cash return annualized over the term of our holding period of that asset. That's a target. Can't guarantee that, but that's the target to be able to hit those numbers. And you need to know that. So the other thing, sponsor, manager fees, and compensation. This one's big because a lot of people talk about this. Again, I'm going over my fund. You need to ask whoever you're looking at, whether it's me or someone else, because I can only speak on what I'm doing. I see a lot of other people and what they do, but here's what I did. So if you're in real estate, because it's a real estate fund or real estate syndication, typically it's industry standard. It really is that they're going to get a couple of fees. They're going to get an acquisition fee. I'm not going to write this out. Ours is 1%. That's 1% of the actual purchase price of the asset, right? So if we bought a deal for 50 million, we get $500,000. That would be the acquisition fee. It's a one-time fee at the time that we close. And that fee is because we put the deal together, we put the team together. It's a lot of work to get a deal. All the deals that we've underwrote prior to that, going out to the property, the due diligence, all the upfront cost that goes along with those things. Um, all of those things are basically the acquisition fee. All right. So that's one fee. Another fee that fund managers and sponsors get is the asset management fee. I'm going to use my other pen. The asset management fee. Yeah, and that's 1% for that. And we charge 1%. That's like half of what some other people call some people do an acquisition fee. That acquisition fee could range from 1% to 3%, depending on the deal, depending on the sponsor and the fund. Asset management fee, that could be 1% to a point and a half to a 0.75 to 3%, depend on the sponsor and whatever it is that they're doing. We do 1%. That's less than BlackRock, less than Blackstone, that's less than I think Fundrise, that's less than who else out there that does some like I think it was like Realty Mogul. Some of the other things that you do and you go on and you see some of these crowdfunding platforms, you can take a look at some of their asset management fees and they'll do that. Um, Asset management fee can be done in two ways. It could be done in a way that the 1% is coming off of the gross collected income of the property, or it could be the 1% of the allocated capital raised. So like for us, we have a $50 million fund. So we would at our it's our right to do that, right? For compensation is to take a $500,000 a year asset management fee because we got to keep this thing going. So, and if we're in a deal for 10 years, that $500,000 is going to get eaten up pretty quick. One lawsuit will wipe that out. Not towards my investors, but if we have to handle something, it has to get handled. That's not a property management fee. That's an asset management fee. That is for managing the asset itself, managing the managers, taking those phone calls, following up. Hey guys, do this. Getting on a phone call with the bank every quarter or whatever it is, all the reporting that we have to do, all that stuff is handled through the asset management fee as well as salaries and paying people and all the other stuff that we have to do that make sure that we manage your capital inside of a vehicle, inside of the real estate over long periods of time. So when you hear people complaining about fees and they charge fees because they don't understand the actual investment, or if you're more sophisticated, you're a limited partner, passive investor, this is what they're talking about. It's not, this is an industry standard. This isn't someone overcharging. This is normal and our fees are cheap. So we have this one. This is a disposition fee. We call it dispo fee. This is 1%. We have a 1% disposition fee. This is preparing the property to sell this later. Like let's say 10 years from now, we've been in the deal. Now we're coming to market. We are doing the same thing it took to buy in reverse. We're going to go to a broker. They're going to give us a BOV, which is a broker opinion of value. We're going to probably go to two or three of them. They're going to underwrite it. We're going to have to prepare documents. We're going to have to notify the management company where anything that we need to get done is going to be done. And then we're going to go to market. We're going to have our review period. We're going to turn around and sell the asset. We're going to pick the right buyer group that's going to buy from us, whether it's an institution, other syndicators, or a big firm, a group, and we're going to sell. That takes money, it takes time, it takes resources, it takes people, it takes everything. So that is the other fee. That's also an industry standard in real estate syndications or real estate funds. There's typically a disposition fee of selling the asset that comes to the GP side. Um, so that's important to know because those are it's one. Those are the fees. Now we have a fee. Very few people talk about this. We have a refi fee. Right? A lot of people miss this, right? Because this is important. Depending on the type of fund or syndication you run, let's say, because that's our goal is to refinance our property at some point, give our investors all of or as much as we can recap our investors their money back. There's a fee for that. So let's say we refinance and we sign on a new loan, that's another 7 years, or I did sign on a new loan, not you. I would take a 1% fee of the loan balance. That would be included in the refinance. So that would be taking care of my people, all the costs that was associated. We got to run this whole thing all over again. That's another fee. That's 1%. Right. Now, I cannot take the fee. I can opt to not do it, but I am entitled to it because it's in the documents, which we'll go through later. And then we have the promote. That's 20%. If I do a good job, because this is what's happening, 20 years, and let's say we're in a deal for 7 years. I don't get any money for 7 years. This is nothing. That's gone. This will come out once a year, right? Or once a month, however we break that up, 1%. And then this right here only happens when we sell. So I may not get this if we're in it forever. I'm not going to refinance it 1,000 times. It'll be like once or twice over that time period because I can't go back to the bank and refinance, or anybody can't go back to the bank because typically you'll have what's called it's a prepayment penalty, but it's like a defeasance fee, things like that that has to burn off. You can't just keep going back and refinancing. So this is the only thing is here. So if I do a good job, make you money, whatever profit is over and above what we pay for the property, giving you all your money back and all this stuff is taken care of. This is what this is the only time, right? So this is where the money actually comes from. So it's not, it's a fee, but so when you hear people in private equity say it's a 1 in 20 or 2 in 20, this is what they're talking about. But you need to know that if you're doing due diligence on a syndication or fund manager, is again, like I said earlier, will they explain like what are their fees and compensation? Like all of this right here to me is, this is the compensation. These are fees, these are compensations. Hey, we get 20% of the upside that we made on the property by doing a good job. All these right here just kind of keeps the wheels on and managing the property and the company until things work, right? So I was going over that because you need to see these things. Like these are very important because people, if you're doing your due diligence on someone and they don't want to show you or they, hey, it's in here and they kind of graze over it, you should be able to have those conversations back to transparency. Next, reading the docs. If you want to go read our docs, you're welcome to do that. It's there. You get access to them. You can go to bell-capital.com, and you can just go right into our investor portal. You can have to register, right? Sign up, join our investor list. You get access to Fund One. You get access to the documents, the private placements in there, the operating agreement, the subscription is in there, the wiring stuff, the LLC document that gets filed for Bell Capital Fund One. You can go online and Google. You can see that we have our SEC filing and all the other stuff that is there. The Reg D filing that's handled. If you want to talk to us, have questions about that. You want to talk to our securities attorney to have questions about whatever's going on in the securities world. All that stuff is available inside of our investor portal or contacting us, feel free to do it. But that's why you have to read the docs, get access to the docs if you're vetting somebody so you get a better understanding of the private placement agreement as well as the operating agreement. And if you have questions, you should be able to walk through it, like the fees. What does a capital call look like? It's a fund, so it's a discretionary fund, meaning like I have full discretion. I make the decisions. You're investing based on, you know, my knowledge of the market, my knowledge, my team, the deals that we pick. So you understand that. But what does it look like? What decisions is Victor responsible for? What if he has to do, like we said, a capital call? Like, I want to do the deal. We did the subscription agreement, Vic, or whoever you're working with. And now we just know that we're waiting. He finds a deal. What is the steps? He picks up the phone call. He picks up the call and says, hey guys, we got a deal. Start getting your money in. Like, what does that process look like? All of that stuff is in the documents, and you can feel free to give me a call or someone on the team. And then last but not least, aside from reading the docs, access to the docs, which goes right back to transparency, is it a deal or not a deal for you? It's okay for a deal to not be a deal for you. Or if you're looking to invest in a fund, like me, myself as a fund manager, I can show you the deals we're looking at. I can show you the consistency, the quality of the deals we're looking for. And as you see those, you can say, you know what? I like what you're doing, but I don't want to be in those type of deals. Some people do only value add deals. They do only value add deals and they do them all like South, or they do them all in Georgia, they do them in Florida, they do them in Texas. Like, and you may say, you know what? I want to do a value add deal, but I don't want a heavy lift. I don't want to be in an investment that goes all the way to the studs. Or like for us, we like deals that cash flow. Some people don't. Like I want to be in a deal that the day we close, we know that there's cash flow on that asset, right? We're not a development asset acquiring a development deal where there's no cash flow for 3 years. You need to decide by vetting the sponsor, vetting the fund, vetting the syndication, whether the deal itself is not a good deal for you based on the investment you want to make. So, because when you're vetting a real estate syndication or a real estate syndicator or a real estate fund, you want to know when to walk away from a deal or when to be like, yeah, I really like it. I'd rather do the paperwork. I want to get in this fund. I want access to those deals and still be able to say yes or no when the deal comes in. But you want to be able to secure your spot by knowing what your qualifications are and what makes a deal or not a deal for you. So I wanted to do all that. I think that's all of the stuff I wanted to go over with you guys. So as a quick recap, vetting a syndicator, a syndication or a fund, you want to be able to find out about the sponsor. You want to be able to ask questions, a little bit about that person or enough about that person. You should be able to. You should Google them. You should get on the phone with them. You should add, can you sit for coffee? Can we come in your office? Whatever that is, doesn't matter. What are the red flags? What are your red flags? There's multiple red flags. Like there's a lot of people I meet that are probably great investors that I just don't favor them. There's a lot of people that I meet that I don't like their deals, but I really like them. So you need to know that. And just also know that if you're going to be hard on a sponsor or a fund manager, and you should because you're protecting your capital. But if you're going to be hard on them, just understand they're vetting you too, right? So be mindful. The other thing, trust. Do you trust them? Can you trust them? Do you trust the fact that maybe they've lost money in the past and they've learned their lesson, or maybe they've never lost a dime and was like, when will that happen? You need to understand that. And are you willing to make an investment? And you shouldn't be willing to make any investment without knowing whether you trust the person and you want to continue to invest with them long term, no matter what they went through, right? Next, are they transparent? Can you talk to them? Could you see them? Are they able to answer your questions, spend some time with you? Do they blow you off because your check is too small? Or do they only want to talk to people with like a million, 2 million, 5 million, a family office? And when it comes time to talk to the little guy, they don't want to have a conversation, a little guy or little gal, they don't want to talk to you. You need to know that. And that comes out as it relates to will they be transparent with you and sit with you and talk to you and share. Next, evaluating the value add, right? What is value add to them? And does that mean the same thing for you and your specific investment? Because let's face it, it's your hard-earned money, and you need to know how that person plans on adding value and continues to add value and make sure that their assets continue to go up because that's the game, whether it goes up or it's stable or whatever. You are investing long term with a fund manager or a syndicator, and you need to know that the asset that is producing the returns is going to continue to have value over long periods of time. Even if you're just buying a trophy asset and stable, like I tell people, we try to invest like a bank or a life insurance company. So we're looking at stable assets, great locations, and that is the value. We're getting trophy assets or trophy locations or deals normally people can't get because they'll always be valuable no matter what. We'll always have a buyer. That's my way of thinking through stuff. Downside, are they trying to protect the downside? Let's face it, if you're investing money, if you can take care of the downside and take care of the upside, you might make some money, right? It's a Warren Buffett thing. It's like, hey, we can cover the downside. The upside may take care of themselves, but let's lean into this thing with rule number one, don't lose money, right? Is that able to be handled? And nobody can guarantee you're not going to lose money. The world can come to an end, and if that happens, you're going to lose your money. And if it does, money won't matter anyways. But you need to know that whoever you're vetting has already covered in his mind, evaluation, some process that they run to cover the downside for their investors and the asset. Next, the financing risk of debt. Like, did they make the right risk assessment on their financing for the debt? 60, are they below, like they're not like eight, they're really high loan to value. They're not at 80% financing. They're not over leveraged. They're not under leveraged. They're not putting themselves at risk. They're not putting your money at risk. They're not putting themselves at risk because if they're a fund manager or syndicator that times themselves out and they're not going to make any money on the deal, they're going to stop paying attention. And you need to know that too. You want your partner as a limited partner, you want your general partners to win as well. So don't try to choke them out. Next, do you understand their targeted IRR and their targeted equity multiple returns that they're telling you that they want to hit? Can they explain it to you simply? Now, I know there's complicated ways to do that. Everybody has their investment calculator that spits out the IRR and everybody else can finagle the numbers, but can they have a simple plan to say, here's what we're going to do. We're going to increase the value by increasing the rents by 5%. Then we're going to do that again and we're going to hold for long periods of time. And we'll hold it until we get it because these are our targets. And if we can get them, we'll do it, right? Like you need a simple explanation of that. The more confusing somebody is, it doesn't make them smarter. That just makes them more confusing because they're trying to look smart. Next, do you understand the sponsor and management fees and compensations? Are they able to explain like I did? Or do you care? Or maybe you go, oh, I don't want this person to have an acquisition fee. I don't want you to make any money. Like you need to know that that's how you are, right? Like they shouldn't get rich off of your backs, right? There's a what do they call everyone talk about like being equally yoked and stuff like that. You know, how much skin do you have in the game? Like, well, you're gonna have some people like me, like I have a lot of skin in the game, right? Like I'm always the first investor in the fund. I'm always gonna allocate certain money from my acquisition fee back into the fund. Maybe I won't take it. There's always gonna be a time where I'm gonna have money in the fund, I'm gonna have time in the fund. Like everybody's gonna have allocation inside of their fund from a GP side, no matter how they go about doing it, right? But you need to understand their fees. You need to understand that they are being compensated. They should be compensated as a partner. You want your partner compensated if they're doing all the work and you're getting passive income and cash flow from this asset for any extended period of time. This is a business, and you should want your partners to make money in their business too. So you got to understand those fees or at least ask them. It should be clearly explainable, like I just did. Where we at? Oh, you should be able to get access and read those documents prior to making anything, prior to making a decision, prior to wiring any money. And you guys know this. You should be able to read the documents and get a good assessment, do your own due diligence, take on like no fund manager or syndicator is giving you financial advice. They're giving you advice of what their investment is, and you are going to enter at your own cost to go and do your own research and feel good about that investment and then go do it. But I can tell you this, if you don't invest, you'll get nothing. If you do invest, you have the opportunity or the possibility to get something. No guarantees. It never is going to be a guarantee. All the documents say, if you read all those documents, it's going to scare you. It's going to scare any investor that's new. That's basically going to say don't do it because they're sharing with you all of the risk associated with investments. But if you're sophisticated or not sophisticated, you understand that all investments involve risk, it involves loss, and you need to be able to see that in black and white, which is what those documents are going to let you know how those risks play out. And then last but not least, you need to have a filter that says deal, no deal. And you need to be able to decide fast. If you did all of these vetting, if you asked all these questions and you got all the stuff that you needed from that, outside of the sponsor and then looking at a deal that you feel like, hey, this is a good investment, that is the best way. You should be able to vet sponsors, fund managers, and deals as a limited partner or a passive investor like a pro. And this should help you do that. So I wanted to make this video to kind of go over a couple of things. Again, I'm sharing all this with you for your own purposes about vetting. The other side I wanted to share with you guys was that there's never any guarantees of any investment working out. You could have run the risk of doing that. These are targets. No promises are ever going to be made. Just because somebody did great in the past doesn't mean they're going to be great in the future. Your odds of them being great or doing great in the past doing something better in the future with a great property or a great asset or the experience and a team, great location, timing of the market, your odds are better, but they're never guaranteed. So I just want to be clear on that. But I hope this helps you become better as a better vetting. Do your due diligence before you wire a dollar, before you make any decisions. You know, build your own little list. You don't have to use this, but I wanted to share with you. These are things that I think through for myself as being the general partner, the active partner in deals, whether I'm doing it with somebody else or myself. These are things I'm looking at. Like, hey, can I do this? Do I want this? Uh, what if something goes sideways? If it went sideways, can we get rid of it? Will we be a total loss, partial loss? Could we get out at break even? What's the financing? Is there financing? Could we do creative financing? If it's a traditional institutional quality deal, who's the lender? Fannie, Freddie? Can we refinance it? I ask those same questions. So I'm vetting the deal and myself and my team and the operators and the property managers the same way you would as a limited partner investing with me, right? And you need to have that level of consistency because I'm an investor. My money's going to be in these deals. I want my money out. So, anyways, I share that with you guys because I thought it was valuable and I wanted to put this on our YouTube channel, and I'll share it a couple of other places too. And yeah, I hope if this helped, let me know. Leave it in the comments. Like this video, share the video. I'll give it a thumbs up or a thumbs down. Don't be a hater and a hider at the same time. But either way, I want to help you guys become a pro at vetting real estate syndications or funds. And I just shared a little bit about what we're doing at Bell Capital with Bell Capital Fund One. Again, you got to be accredited, or you got to at least have 200,000 because our minimum is 200,000. You got to at least have 200,000 or more to invest, and that's available. If you're not accredited, this is an accredited fund, or you have to have 200,000 or more to invest because the SEC letter says basically that if you have $200,000 to invest, that is seen as a substantial investment and you can invest. So let me know if you guys need anything. Go to bell-capital.com. Go ahead and join our investor list. We only send our information about upcoming webinars, opportunities at the office for Bell Capital. And we have something new that we're doing right now. It's called Private Wealth Club. And this is just for people who want to build private wealth for themselves and their family through investing in real estate. So we go over a lot of this about if you guys are looking for a second stream of income, you have a W-2 job, you have a business, and you want to actually start investing in real estate, whether it's active or passive, we're going to go through exactly how you do. You can do it on your own, or you can invest as a passive investor and get the same returns and values and all the other stuff as by riding along with somebody else without creating a second job or a second business for yourself by just being an investor, which is how the highest level of people on this planet do this game. They don't all go off and do the other do deals by themselves. Um, they don't have the time. They're busy, focus on whatever they do to create income and revenue for their, whether it's work or whether their jobs or their businesses. They invest their money. And that's how they actually create real wealth, private wealth for themselves and their family. And that's what we're doing right now with our private wealth club. So if you're interested in that, leave that in the comments. We'll get you over information about that, and we'll go from there. But if you guys need anything, let me know. Have a great day today. Let's get after it.